What's up, guys? Metapunk here. Today I'm going to talk about the bank runs that took place earlier this year, and how I see many more taking place in the near future. Alright, so this video is mainly going to be centered around the three bank failures that took place earlier this year. So it's going to be on Silicon Valley Bank, Signature Bank, and also First Republic. I think these bank runs are a bigger deal than people may think, and I feel like they didn't get the coverage that they should have because this is the first time since the 2008 Great Recession that three financial institutions failed within each other in such a short amount of time. And these bank runs stopped a streak of 868 consecutive days with no bank failures. And it's the second largest stint since 1933. So I think this is a huge deal. And it's going to have a bigger ripple effect for other banks in the future. Alright, so first off, I have an article from The Wire, and they state that the last 2 months witnessed three of the four largest bank failures in United States history. And it consisted of First Republic, Silicon Valley Bank, and Signature Bank, which are currently the second, third, and fourth largest bank failures in United States history, which was behind the 2008 global financial crisis. So the combination of these three failed banks altogether held assets of $532 billion, which surpassed the $526 billion that were owned by the 25 banks that failed in 2008. So yeah, overall, these three banks lost more than $6 billion compared to the 25 banks that failed in 2008. So I think that's a huge deal. So if only three banks of this volume lost this much money, I really think there's going to be many more that are going to fall behind, especially if the Federal Reserve continues to fight inflation by raising interest rates. So if that's the case, we could possibly see a market pivot. So according to the FDIC, the last bank that failed was all the way back in 2020, and that was the Alameda State Bank. And then you can see the most recent ones that we have are the Silicon Valley Bank, Signature, and First Republic. So it's going to be interesting to see if we have many more on this list within this year. So next up, according to Wikipedia, the last big bank runs that we had took place during the beginning of the Russia and Ukraine conflict. So we had many depositors taking money out because of a lot of the instability and fear that was going on. And then another big catalyst was when SWIFT removed Russian banks from the SWIFT system. So that caused a lot of panic overall. Alright, so now I'm going to show the charts of the three banks and the overall impact they had on the markets. So if you look within the last couple of years, the top overall value of Silicon Valley Bank was $753. And then if we zoom in a little bit within the next year, at the start of the year, it was around $250 to $300. And then it started to slowly decline. And then around at the start of the bank failure, it dropped significantly down to $100. And then it bottomed out around a little under $1. So since then, it continued to consolidate and just get lower and lower and lower. And currently we're at around 44 cents. So this bank run brought a massive loss of liquidity to the people holding money within the bank, and then also the people investing into the bank. All right, so next up we have Signature Bank, and the top of this market was around December 2021 and January 2022, and it was a price of around $360 to $370. And then since then it started to decline. And then if we zoom in, it kind of topped out around $103. And then since then, it just went all the way down to 13 cents and had a steady consolidation period. And then lastly, we got First Republic Bank. And this one started to top out around November 2021. So this was around $220. And then since then, it started to slowly decline. And then if you zoom in to this year, before the top, this was around March 7th. It was around $120. It didn't all the way go down, but it did have a major drop. So it went down to $31 in March 13th. And then since then, it had a slow consolidation period where it continued to decline. And then if we go all the way down to now, it went down to 43 cents. So once again, you go from hundreds of dollars to cents. That is a massive sell-off. And the crazy thing is, I want to compare this to the failures that we saw in the crypto space with Terra Luna and also FTX. I see them as very similar events. And when we were seeing those failures in the crypto space, a lot of people in the crypto community were stating that the same thing could happen to the banks. And I saw mixed opinions. Some people were agreeing, and then some people were saying the banks would never fail at this level. But now we're starting to see the same thing take place on both sectors. So since then, the FDIC released a new deposit insurance system on May 1st. And it just overall enhanced the coverage of the depositors of the banks. So because of this, the United States Treasury had to inject a lot more liquidity into the banks to bring more stability into the banking system and also the markets as a whole. All right, so if we look at the US dollar index, or the Dixie, you can see that it started to top out around November 2022. And this is actually around the time that the FTX collapse happened. So there was a lot of FUD and fear. But overall, since then, it started to rapidly decline. And for the people that don't know, when the Dixie declines, equity, commodities, and crypto tend to go up. So since then, there was a lot of FUD, and you can argue that that was the bottom. So it had a massive decline all the way to February. And then since then, it had a decent rise back. But since then, around the banking collapses, we saw another decline. And since then, we can see that the market, whether it's crypto or the stock market, continued to rise. So if you look at the S&P 500, if you go around the October, November area, you can argue that it started to bottom out around here. And then since then, it just continued to rise all the way back up. And then if you look at the Dow Jones, same thing. October, November, it started to bottom out. And then it continued to rise back up. Same exact thing with Bitcoin. Bitcoin went all the way to $15,000 and then it just didn't look back, continued to go up. And then lastly, we're going to look at the gold charts. So if we go all the way down here, around October, November, this is the bottom. And then since then, it had a significant jump, which is insane. And we're from around $1,600. And then it had a nice little local top around May. And then since then, it declined, but I think that it can continue to rise back up. So if we go to the corporate side of this, since June, there's an increase in defaults between corporate companies. So far, there's been 41 in the United States so far. And that's more than double since last year. And then they also state that companies are defaulting on their debt due to uncertain economic conditions and heavy debt loads. Having higher interest rates made it difficult to refinance as debt is more expensive. And then they lastly state that bankruptcy filings in the United States has had a sharp rise. And then we haven't seen levels like this since 2010. I think this is important because this is only one sector. So overall, we still have real estate, the banking sector, supply chains, automobiles, and just many more sectors of the economy that rely on debt to keep the economy going. So the main thing happening right now is that the increase in interest rates is really affecting all these sectors. And we stated this in my earlier videos. If we look at the QFS video, I stated that higher interest rates is going to cause more defaults and possibly bank runs. And now we're seeing it now in real time. So this is why I think that the Fed might go into a pivot. I'm going to get into that a little bit later in the video, just not right now. So now we're going to talk about the bill that was just signed for the United States debt ceiling and how it's going to affect the economy and the markets. So Joe Biden signed a bill that suspended the U.S. government's $31.4 trillion debt ceiling, averting that it would have been the first ever default that took place on the debt ceiling. So this bill suspended the debt ceiling until January 1st, 2025. There are many ways that the government increased spending in this bill, such as defense and also auditing with the IRS. There were definitely a few cutbacks as well. So I think from now in 2025, we're going to see a bigger increase in government spending, not even just in the United States. I think other countries may pivot as well because they're starting to claim that inflation is starting to decline and we can start to take it easy on the interest rates. And I think that it's important to show this because the United States, we basically run on debt. And if there's any more catalysts that hinder us from issuing debt, then the system is just going to collapse and become a lot worse. So I think there's going to be many more catalysts that may cause us to pivot and go slower on interest rates. Okay, so now I'm going to get more into why I think they're going to pivot. So you can see here that the Federal Reserve is pausing interest rates for the first time in 15 months. So the Fed pausing interest rates for the first time after 15 months is a change that can offer a hint of relief for consumers who are grappling with higher price mortgages, credit cards, and other loans after 10 consecutive rate hikes. So there's a big difference between the interest rates that we saw back in early 2022. A conventional 30-year mortgage loan was about 3.2%, and then now it's currently 6.8%, which means that a monthly mortgage is now over 50% more of the original price. And then also credit cards hit a record high, which is now over 20%. So yeah, their main goal was to fight inflation, which has been the highest it's ever been in 40 years. They also state that there was good news in the recent federal data that showed that their effort is working, with May's consumer price index rising at its slowest pace in 2 years. Because of the progress of inflation, economists had expected that the Fed would hold off on another rate hike in order to gauge the economy's strength or to make sure that they're not over-tightening. So even though Jerome Powell did pause the interest rates in his most recent FOMC meeting, he did later on come out and say that from now to the end of the year, there most likely is going to be more interest rates coming. But once again, I still do not believe him because since March, when we had the first initial bank runs, that's when he started to lower interest rates to around 50 basis points to 25 basis points. And then since then, we start to have the pause. So I'm going to go over to the federal funds rate. So you can see all the way back in August 2022, we're at around 2.5% for interest rates. And then since then, we had a large increase. The Fed, they're hiking rates to around 75 basis points. And then you can see towards around here, we're getting 50 basis points. And then since March, that was when we had the first decline to 25 basis points after the banking crisis. And then since then, it just seemed like they went a lot more dovish. So you can see here, way more hawkish, way more aggressive on fighting inflation. And then since March, you can just see the slow dovishness right here. And then all the way in June, this is where we had the pause. I'm seeing a trend of the Fed becoming way less aggressive. And to me, this is an indication of a pivot, in my personal opinion. Because once again, if they continue to do an aggressive rate hike, I still think that it's going to cause more insolvencies in banks and different institutions. And I think it's going to cause more instability. The thing is, if they do continue to pivot and they start lowering interest rates, it's definitely going to go against to what the Fed was saying on fighting inflation. But I don't think they're as serious to fighting inflation as they say they are. And regardless, let's say they do continue to increase rates, it's going to cause more black swan events in the banking sector. So at the end of the day, they're going to have to increase liquidity and issue out more money. So at the end of the day, it wouldn't make sense that they pivot and start lowering interest rates because they can't deny the inevitable. Okay, so now I want to end this video off with talking about FedNow. So now we have the Fed lowering interest rates. We have the United States suspending the debt ceiling limit. And then now we have the FedNow going live in July. And this is going to help enhance the government, institutions, and other corporations that sign up for FedNow. They're going to get instant access to money 24/7, 365. And a big comparison to FedNow that a lot of people like to say, it's kind of like the government version of Zelle. You know, when you send Zelle transfers between banks, it's like instant settlement times and it's feeless. And then now it's going to do the same thing to the people that are part of this new system. So getting into what it's about, it's a new instant payment infrastructure developed by the Federal Reserve, and this allows financial institutions of every size across the U.S. to provide safe and efficient instant payment services. Through financial institutions participating in the FedNow service, businesses and individuals can send and receive instant payments in real time, around the clock, every day of the year. Financial institutions and their service providers can use the service to provide innovative instant payment services to customers and recipients that will have full access to funds immediately, allowing for greater financial flexibility when making time-sensitive payments. So yeah, this is a big catalyst as to why I think the Fed is pivoting, because now we're entering into a new kind of monetary system. The thing with Fed now, it's not directly a CBDC because there's no digital currency behind it, but I still think it's very similar from a domestic standpoint. And I think it's going to greatly set a precedent of people and institutions utilizing instant digital payment systems. So that's the thing. Let's say there is another black swan event that takes place between the banking sector. This is where I think FedNow will come in because now we have more ways to send money and liquidity between institutions. And it's also directly linked to the Federal Reserve. And an interesting thing with FedNow, there's a lot of fintech and also cryptocurrency-based systems on here. So we have different banks and institutions that have their own solutions, and banks and institutions that actually utilize cryptocurrency and DLT systems. So for example, you have BNY Mellon, Oracle, Volante, Finastra, MasterCard, and many of these other services that are traditional firms, but they utilize some sort of cryptocurrency or DLT system. We have Cypherm over here, which is the actual DLT cryptocurrency network. I made a few posts on my Instagram account, on my Instagram stories. This is another showcase, the Metal blockchain. They were showcased in the FedNow service. The weird thing is, I tried to go back to this link and it was no longer there. So I'm not sure if this is 100% going to be on there. Same with Cypherm, but the fact that they're showcased, I still think it's a big deal. And another post that I made, these three are all Ripple partners. Oracle is used with Quant, and MasterCard has multiple partnerships with crypto networks. So I think it's interesting that currently now we're starting to see a pivot in the crypto market. A lot more institutions and firms are more bullish, and they're actually implementing some sort of cryptocurrency service. And then now we have FedNow going live in July. So we could possibly see a big influx of investors and just overall greater market sentiment in the cryptocurrency space because of FedNow. All right, so that's the end of the video. Thank you so much if you made it this far. I really appreciate it. So yeah, quickly before I wrap this video up, I want to state that if you don't follow my Instagram account, I highly recommend you follow because I've been really active on there. I haven't been too active on YouTube because I just haven't had the time to make YouTube videos like I did back then. But I still try to keep you guys up to date on Instagram. So yeah, overall, I think the banking crisis is looming in the background, and there's still a lot of issues that could take place if the Fed continues to do their current monetary policy with the increase of interest rates. Overall, it still really is early to say that there's going to be a pivot because they were only hiking rates to 25 basis points since March, and we only had the first pulse since June. So it's really hard to say that they're going to 100% pivot now because there hasn't been any significant damage since the first three initial banking collapses. But like I said, if they do continue to hike, who knows how it's going to directly affect the banking sector. But at the same time, we do know that it is a catalyst for more failures. And we also got to take into account that the BRICS nations, they're expanding their exposure to cryptocurrencies now, and the de-dollarization narrative is increasing. So if we combine everything, the Fed pivoting, the new FedNow digital payment system, and the BRICS nations expanding to other forms of money, to me, it seems like we're transitioning and then we're actually entering into that new monetary system that a lot of us in the community have been talking about. Not to say it's going to happen right away, but it definitely seems like we're in the beginning of a new change. In another video, I'm going to really go in depth on the adoption that's taking place from all sides, whether it's the United States or other BRICS nations, even Europe, so you can get a better idea of what I'm talking about. So it's your boy Metapunk. Thank you for watching, and I'm signing out.